Hey guys, welcome back to the show. Today we're going to talk about asset location, putting the right assets in the right accounts to maximize the efficiency for taxes in your portfolio and to build bigger growth. Coming up next, Fighter Financial Toolbox. Join me. Hey guys, welcome back to the show. The ultimate goal in our portfolio is to build as much money as we can for our retirement. There's certain ways we can do that. Asset allocation is important, but also asset location is important. What asset location is putting the correct assets in the right spots, in the right accounts to maximize tax efficiency. Okay, so let's look at, we have our three buckets. First, we have our taxable account, we have our tax deferred account, and we have our tax-free account. Remember, we always want to use tax advantage accounts first. So, what are our tax deferred events? Tax deferred are your 401k plans, your 403bs, your 457s, or if you have any traditional IRAs, that's tax deferred. That's money that grows. Tax deferred, you don't pay any taxes on it while it's growing, and when you pull it out, it comes out as ordinary income. Or otherwise it comes out at whatever your taxable rate is at that time. Let's say we're 22%. Over here in the tax-free bucket, we have our Roth IRA assets. You all know I'm a huge fan of Roth. Roth is, money goes in after taxes, so you don't get a tax savings, but as long as you have the account for 5 years and you pull it out after 59 and a half, it's tax-free. Remember also, you can take out your contributions anytime. So this is our tax-free bucket. This is the stuff we want to grow for a long time. Over here, we have our taxable account. Our taxable account, now most people have taxable accounts and don't even know it. This is your emergency fund. If you have your emergency fund in an online savings account, that is a type of taxable account. Anytime you have cash, if you have any CDs, those are certificates of deposit. If you have a money market account, those are all taxable accounts. Also, when you think about taxable, people think about a brokerage account. That's where they have their individual stocks or sometimes ETFs, usually stocks. Once in a while, they'll have a municipal bond because they don't have their tax-free in the state that you own them. But let's talk about the investing part of it. So 401k, most people have those, right? This is a standard. We have some sort of workplace plan, whether it be 403b if you're a teacher, or 457 like us firefighters do, or other governmental employees. This is where you want to put all your bonds, if you have them. Why is that? Because bonds put off income. They put off interest on a regular basis. Some pay monthly, some pay quarterly, but they continually put it off, and that money always comes out as ordinary interest. Always. We don't want to pay taxes on that. So if we put that, we know that when we pull out the traditional, we're going to have to pull it out and it's going to come out as ordinary interest. We may as well wait and tax defer as long as we can. Also, if you have any REITs, REITs also pay interest. And because of that, they pay dividends and they pay them quarterly. Now, those dividends cannot be qualified and they always come out as ordinary interest. So this is something we want to be tax deferred as long as we can, so we're not paying interest on that at the time. Let's go over to our tax-free bucket, our Roth. Now, Roth is where we have our longest growth period, right? This is where we want to have, if we have individual stocks that pay dividends, if we have any kind of ETFs or mutual funds that pay dividends. Also, if we have any actively managed funds, let's say active managed mutual fund, we're going to want those in the Roth because otherwise we're going to have to pay cost on the turnover. Also, this is where you want to have your small cap and your growth stocks, because you have the longest time for that to grow. And when you pull it out, it's tax-free. In your traditional account or your 401k, and this very well may be the only two that you have. This may be bigger than this one, of course, because of the contribution limits. But let's say that in your 401k plan, all you have is a general bond account and an S&P 500 account. So you've got a low-cost index fund, the S&P 500. You've got your American stocks taken care of. You've got an intermediate term bond or some kind of bond market, or even a stable value fund. Stable value fund is basically a cash fund. I'm not a huge fan of them, although people are not in favor of bonds right now, so it might be something to think about. Okay, let's talk about a taxable account. Now, if we have a taxable account, this is where we want a total stock market index, right? Or international index. Why do we want index funds? Because index funds do not create as much turnover because they're not buying and selling. Also, if we have any individual stocks that we are going to buy and hold, only if we're going to buy and hold them. Because if we're turning stocks over, buying and selling them on or day trading, we're going to be paying taxes every time we make money on them. If we buy and hold them, we can get them out at long-term capital gains rate, and we'll talk about that in a minute. Long-term capital gains and qualified dividends. What does that mean? To be a qualified dividend, a stock has to be either based in the United States or have a significant presence in the United States. To become qualified, you have to have held the stock at least 60 days before the qualified dividend date. Now, that's usually paid quarterly. So usually when you buy a new stock the first time, or even a plan, initially they're not qualified. But if you hold them, they become qualified, and those get taxed at 15 to 20% instead of ordinary income, which we said, let's say we're 22. Also, long-term capital gains rates, these are the same. Now, what happens if we sell it before, long-term capital gains is over a year, more than 1 year. Now, what if we sell it before a year? Then we have to pay, then we have a short-term capital gain. That is paid at your ordinary income level, whatever that is at the present time. And it's all payable in the year that the event occurs. So if you get a dividend payment in March of this year, you're going to pay for it at the end of the year when you do your taxes. If you sell a stock that's appreciated in value or a fund, any of that, you're going to pay capital gains on that. And if it's under a year or less, you're going to pay at your ordinary income level. So remember, on your taxable account, guys, we always want to buy and hold as long as possible. All right, I'm going to erase some of this stuff. Let's talk about how we do it. Remember, this year, your 401k limit is $19,000. And if you're 50 or over, you get an extra $6,000 for $25,000. This is my first year being able to get the extra $6,000. In your Roth IRA, the contribution limit this year is $6,000. And if you're over 50, you get an extra $1,000 for a total of $7,000. So, how do we max? What's the best way to put our things? We've talked about this in the past. Remember, guys, if you get a match, whatever your match is in your 401k or your plan, always invest to the match. My recommendation, if you get 6% as a match, and let's say a lot of times you'll see 50% of the first 6%. So really they're going to match 3%, right? So if you put in 6,000, let's say you're putting in for simple math, let's say you make $100,000. So you're putting in 6%, that's $6,000. Now, because they pay 50 cents on the dollar, your company is going to match you $3,000. So you put in 6,000, but there's really 9,000 in there for you. Now, I recommend at least contributing to the match. It's free money. You can't leave it on the table. Once you've done that, my suggestion is to max out your Roth IRA if you can. So 6,000 here, and you've got 9,000 here. You've already got 15,000 invested for the year, and you've got it in you've got some tax diversity for retirement. Now remember, if you work but your spouse does not work, and you make enough money, in this case we made 100,000, so we do make enough to make both contributions, we can also add another 6,000 for your spouse. So now we're looking at $23,000, not too shabby. Now, if we still have some more, then I would say continue until you max out your 401. Once you've maxed it out, that's when you want to consider doing a taxable account. So let me go ahead and erase some of the board again, and we'll talk about taxable accounts. Now, I said before that a lot of us have a taxable account. We don't even really know it because we have our emergency fund here, right? The emergency fund. Everybody should have an emergency fund, 3 to 6 months, just in case something bad happens. All right? So 3 to 6 months of necessary funds. Necessary meaning the payments that you have to make, not stuff you like to do. This is a necessary bare minimum to keep you through in case you, for example, lost a job. Now, how do you put it? Emergency fund. It could be an online savings account, right? Those are good. Right now you can get around 2 to 2.25%, somewhere in there. There are some a little bit higher, but the problem with them is some of them are introductory and then they change. But I use Ally. I get 2.2% on it. I like it. It's current. Okay, so let's say that you have this. This should be money that you can get to relatively fast. It does not need to be locked up. But what you could do is you could say, hey, I've got 3 months of it in cash, and I've got 3 months in a 1-year CD, right? Because you're probably going to get 2.7 to 2.9% on the CD, so you can get a little bit more money. And if you had to break it, you're gonna have to pay a little penalty on it, but why not have it going while you can? Other things, if you've maxed out your other plans, so we've got these all maxed out. Now we want to look at investing in some extra stuff. This is when we're going to buy index funds, stock index funds. And those can be either index funds or ETFs. Remember, ETFs are very tax efficient because rather than turning over things, they do in-kind transfers, which minimize the taxes in a taxable account, which is really important. This is also where we're going to keep our individual stocks if we have them, right? But what did we say? We're going to buy and hold them. We're not going to buy a stock, speculate that it's going to go up and then turn around and sell. We're going to buy it and we're going to hold it forever, or at least a long time. Now, one of the advantages of a taxable account is if you do have a loss. Let me go ahead and erase this. So let's say that I bought one of my ETFs that I have is VEU. That is the Developed Market Index, International Index. Okay, so Developed Market International, and it went down last year quite a bit. I lost about $3,000. $3,000. Now, because I sold that stock. Now I know we usually in one of these accounts we don't ever sell for a loss because it's not locked in if we don't sell it, right? But here I sold for a loss and I changed into a separate international fund, a different fund. You cannot sell a loser and rebuy it, because if you do that within 31 days, you'll get what's called a tax loss and you'll lose the ability to write this money off. So what did that get me? Because I went from VEU to another fund, iShares Internet. I'm out because I'm back in VEU. Anyway, bought into another fund. So I didn't get out of the market. I stayed in the market while I was there, but I took that $2,000 or $3,000 loss. Now, because it's a short-term loss, it is used to offset any short-term capital gains. So some of those monies that I made and dividend payments that I made during that year, this loss actually offset some of the costs that I had from that. Also, if you have no capital gains, which some people don't, you can count this against earned income on your taxes. Okay. So to sum up, the important things we need to remember is, first of all, asset location is important. Anytime we have multiple accounts, we want to make sure that we have the right assets in the right places so we can maximize it. So remember, if we need bonds, bonds are in our 401k or our traditional IRA. If we have any REITs, we want those in there as well. REITs are real estate investment trusts because of the income they put off. In our tax-free bucket, that's where we want our long growth stocks. And if we have any dividend stocks, because we can keep reinvesting the dividends and keep that growing for a long time without paying any money on this. In our taxable account, that's where we have our emergency fund. And that can either be online savings or it could be CDs, whatnot. Once we've maximized both the 401k and the Roth, that's when we want to start thinking about some taxable account investing in a brokerage account. All right, we've talked about a lot of stuff. I hope my whiteboard was not too messy for you guys to understand. If you have any questions, please let me know. If you have a comment, please leave it down below. If you got anything out of this, give me a thumbs up, hit the subscribe button, and we'll see you again next week. Thanks a lot for your time. Stay safe.